Today we're going to be looking at superannuation and other retirement plans. Now, life insurance companies have a major role to play in private pensions business. They are providing an alternative to the government funded, the government run and the government managed schemes. Over the last few years, there has been a rapid growth in life insurance premium levels. But the fastest growing segment has been in the pensions premium segment. Just to give you an idea of the figures involved, a couple of years ago, the pension premium comprised 9% of the total new business that life companies were doing, but now it exceeds 22% and is growing fast. Insurance companies are mandated to provide annuities, and actually they bear quite a high responsibility in terms of developing appropriate schemes, appropriate products. And obviously the options that go with those products. One thing that is being considered is where the member hasn't built up sufficient funds to purchase an annuity. The alternative option could be to take phased retirement or phased benefits. Now that is an option which is not currently available, readily available. And it is an option which perhaps should be considered by insurance companies so that it can be offered in the future. So at present, however, it is possible for individuals to arrange an individual pension plan or a personal pension plan through an insurance company or a mutual funds company. These companies accept premiums. They invest these premiums, they manage these premiums, and at the selected retirement age, they provide an annuity for the individual. These plans can be used by individuals to bolster up or to top up their existing schemes or benefits from existing schemes, such as the statutory schemes, and also they may be used to opt out of these schemes in terms of if such plans provide equivalent or similar or higher benefits. The overview is that the individual pension plan market is evolving fast, and it is worth keeping an eye on it in terms of good schemes coming up, better schemes coming up. And usually the regulator websites for the IRDA and SEBI websites give details of these plans or link to the websites of these companies which offer them. As far as the self-employed are concerned, of course they don't have a scheme of the employer to fall back on. They have to make their own pension provision, and for them these personal pension plans being offered by these insurance companies are a good way to go. At present, of course, they can go via the public provident fund method, which provides good returns. But more and more of these private pension plans which are being offered should be looked at to see if they provide a better option. They usually start at contribution levels of 500 and more. And once the fund has been built up, these funds can be taken and invested through the regular income schemes of post offices or those being offered by the banks. Alternatively, they can be taken to the insurance company and an annuity purchased. Another way of looking at how best to build up pension provision is for a self-employed person would be through their professional body, whereby the professional body sets up a superannuation scheme of which the individual can become a member. The advantage would be that they can then they can as a group invest in a scheme which may provide better benefits. Some of the examples of products which are available at the moment, these products, for example, the Life Insurance Corporation of India has products such as Jeevan, Akshay, Jeevan Nidhi and so on, and a new entrant, for example, the ICI Prudential Life Insurance Company, has schemes or plans such as the Forever Life, Lifetime Super Plan, Pension Plan, and the Life Linked Super Pension Plan. Some of these are deferred annuity schemes and require regular premiums to be paid, whereas others will accept a single premium. The annuity has various options. It can be a joint life annuity. It can be an annuity which provides for a lifetime pension with a guaranteed return, or it could be an annuity which it doesn't provide any guaranteed return. At the end, in the event of the death of the client, the annuity stops. Now that we've been looking at the individual schemes, so let's now turn to the group schemes, the superannuation schemes, which a company or an employer can set up for a group of his employees. More and more employers have recognized the need for providing regular income at retirement, and they are doing this through the superannuation schemes. From the point of view of an employer, providing a good pension plan has the advantage that it acts as an incentive to the employees, and retention of good employees, of valuable employees, of skilled employees is becoming more and more important because of the competition employers are facing now. As far as the structure of a superannuation plan is concerned, depending on how it is funded, they can be categorized into three broad types. First, there is the pay-as-you-go type, under which no funding in advance is done by the employer. As and when the liability arises, i.e. when the employee reaches his retirement age, the benefits are taken out of the company funds, out of the company accounts, and paid out. Now, this has several disadvantages. The main being, if a number of employees have to decide to retire at the same time because of their age, then it places a big burden, a huge burden on the expenses of the company. And it may be that the burden is so big that the employer is unable to meet it, and therefore it defeats the whole objective of being a scheme which provides benefits at the appropriate time if it can't provide those benefits. The other type of structure we have is where the superannuation scheme is funded through a trust. What happens is that an irrevocable trust is set up by the employer, and money is put into this scheme, into this trust, to pay for the retirement benefits. The trustees manage these funds, they administer the funds, they invest the funds in such a way that at the appropriate time money is available to pay for the liability, pay for the pension. Another way is the insured scheme method, where the money received by there is still a trust, but the money received by the trust is directed towards an insurance company, and the insurance company then invests these funds, and at the appropriate time provide the pension to the pensioner, to the member, the scheme member. I would mention the role of private fund managers at this stage. For example, where the scheme is through a trustee managed scheme, as a trustee administered scheme, these trustees may employ private fund managers who are professionals, who can manage the funds better, who know how to invest these funds better professionally, and aim for higher returns. The fund managers usually charge a fee for this service. They have some restrictions, they have some rules and regulations which you have to follow in terms of where they can invest, how much they can invest, as laid down by the pension rules. and they have to follow these rules. They have to follow these set criteria. Of course, where they are associated with an unapproved superannuation fund scheme, they have a much freer hand, and they can aim for a different type of strategy to produce the growth. I've just mentioned the approval of superannuation funds. Well, there are of course advantages to having a superannuation fund approved, and approval means that they have to follow the rules as set out in Part D of the 4th Schedule to the Income Tax Act, and once these rules are met, the Chief Commissioner's approval is available. There are various conditions which have to be met, and the conditions include that there must be an irrevocable trust set up. The funds must provide for annuities for the employees, an annuity to be provided under the fund. The scheme must also provide for benefits for widows and children or dependents in the event of the death of the member. The various tax benefits include tax relief for the employee's contribution. This is available under 80C or 80CCC. The employer's contribution is deductible as an expense, and therefore that gets tax relief. The interest which is accumulated on the fund, that is exempt from tax. And also under Section 10 of the Act, the commuted value, any commuted value taken at a particular age is tax-free. The payments which are made in the event by the superannuation fund in the event of death of the member is tax-free. Payments on retirement due to disability, the member becoming incapacitated, they are tax-free as well. Apart from superannuation schemes, the formal superannuation schemes, there are other schemes which are run by employers to provide pension provision. Just to mention the profit sharing scheme, under which the employer contributes a part of the profit into the scheme, and that could change from year to year, obviously, as it is earned. The disadvantage is that it's not a regular, it doesn't provide for regular funds, it's as and when. And of course, the disadvantage from the employee's point of view is that he can't be sure as to what he will receive at the retirement age. Now let's turn to the social security schemes which are available in India. Well, there are not that many, to be frank. The objective of such schemes is to provide a minimum tolerable standard of living for the citizen. Various statutory instruments have been enacted, such as the Workmen's Compensation Act 1923, the Employees State Insurance Act 1948, so that minimum benefits can be provided to the citizen. However, the unrecognized area or the unrecognized sector have not actually received much advantage out of this. So additional initiatives are being considered, have been taken up by various states to provide benefits in terms of sickness benefits, unemployment benefit, invalidity benefit, and old age benefit to the unrecognized sector. There are different methods of delivering such benefits. They are being delivered through centrally funded social assistance programs, through social insurance schemes, through social assistance schemes, and also other public initiatives have been considered as well. So one of these schemes is the National Old Age Pension Scheme. It was started on Independence Day in 1995, and its aim was to reach the very poor. The scheme is implemented through panchayats and municipalities. As far as eligibility is concerned, it's a male or female who is age 65 or over and is destitute, in that there is no support, financial support from his family or from anyone else in the community. The rate of assistance is concerned, as far as the rate of assistance is concerned, is quite low, 200 rupees per month, but that itself can vary from state to state. Yet another scheme This is a multi-benefit scheme which was started in July 2001 to provide life insurance protection and lump sum benefits and pension benefits to farmers aged between 18 and 50. This has had some success. By March 2006, it was noted that up to 29,000 agricultural workers had been covered. So, in summary, in conclusion, we've covered in this topic, we've covered the role of insurance companies. We've covered the different personal pension plans which are on offer from insurance companies, different superannuation fund structures, pay-as-you-go, funded, etc. The approval conditions which have to be met, and subsequent tax advantages which arrive for schemes which have been approved, and also some of the social security initiatives which have been taken in India. So I stop there. Thank you.